This is the Finance 451 project by Maddie Kresevic. The goal for this project was to analyze 2 industries over 5 years, have 5 companies per industry, determine what company I like best in each industry, and then pick one of the 2 from each industry as the best investment. The industries that I chose were entertainment and telecommunications. The companies in each were 21st Century Fox, Discovery, CBS, Time Warner, and Disney, and then in the telecommunications, AT&T, Verizon Communications, T-Mobile, Dish Network, and Comcast. First, we're going to look at the entertainment industry. So, looking at liquidity with the current ratio, 21st Century is showing the strongest current ratio, sitting consistent around 2. From 2012 to 2014, Discovery fell sharply from 3 to 1. This decline could have been the result of Discovery taking on a lot of new debt, so you can see that is with the red line falling sharply from 2012 to 2014, and then it picks up a little bit back in 2015. For the quick ratio, you can see that 21st Century makes more assets or more on assets per dollar of liabilities than any other company, with the exception from Discovery in 2012 before it fell below. 21st Century is sitting at the top. They are the dark blue line, and Disney and CBS show current liabilities exceeding cash, marketable securities, and accounts receivable by being under 1. As you can see, they have the lowest quick ratio, the light blue and the green lines. The cash ratio kind of looks the same with 21st Century on top. You can see Discovery is the red line and it dips down sharply. The results here with the cash ratio are pretty similar from the current and quick, and from this we can assume that most of these companies' current assets are cash or cash equivalent. Next, we can look at the leverage of the companies. For equity multiplier, you can see CBS, which is the green line. They are taking on more debt consistently each year, but the liquidity ratios we just saw show consistency from them. So this could mean that the debt they took on from 2014 to 2016 is either long-term debt or they acquired assets with the debt they took on. The rest of the companies in the industry are at a steady average around 2 to 3. Disney is shown to have the least amount of debt in the industry, which is again shown in the next graph, which is the times interest earned ratio. Disney leads the industry and shows that they are able to pay their obligations much faster than the other companies, which you can see Disney is the light blue line, greatly above the rest of the companies, and the other 4 companies show more consistency internally and externally to the industry average, having income around 5 times higher than their interest expenses for the year, as opposed to Disney, which is around 30 times higher. For asset efficiency, we looked at total asset turnover, and the industry average shows to be about 0.5, meaning that every dollar of assets generates 50 cents in sales. Disney is showing the highest asset turnover over the 5 years, generating around 10 cents more in sales for every dollar of assets. When we look at profitability, our first ratio we look at is profit margin. Time Warner, which is the purple line, and Disney, which is the light blue line, show the most consistent profit margin, both increasing over time. Discovery shows a warning sign based on the steady decline in profit margin for 4 out of the 5 years. 21st Century, which is the dark blue line that's jumping up and down quite a bit, shows 2 good years of higher than normal industry average. These 2 jumps are not necessarily a bad thing, however, because they still come down to the average, not doing worse than anyone else in 2016. We also look at return on assets for profitability. Other than the two jumps for 21st century, Disney is leading the industry in ROA, meaning they consistently have good management and utilize their assets to get good return. 21st century and CBS, the dark blue and the green lines, have recently been steadily declining since their big jump in 2014. Profitability. For return on equity, you can see that Discovery, Time Warner, and Disney all have around the same ROE and are all steadily increasing, which shows these companies are continuously generating profits with the money shareholders invested. CBS is also increasing despite when it fell back to around company average after spiking in 2014. CBS and 21st Century are consistently above the company average, CBS being more promising due to having the highest ROE in the past 2 years. Next, we have ROE broken down into interest burden times tax burden times operating margin times total asset turnover times profit margin. We break ROE into these components to determine which of these components is most responsible for changes in ROE. For example, going back onto the graph, looking at the spikes in 2014 for 21st Century and CBS, the green and the dark blue lines, you can see here that this is a result of a high profit margin for 21st Century and a high tax burden for CBS. Now looking at market value measures, we have the price-earnings ratio, and it shows for 2013 that investors saw expected growth in Discovery for the year. This could have been from possibly a new movie coming out that investors believed would increase the value of the company, and clearly it did not, since they returned back to around the company average in the year 2014. All of the other companies have stayed pretty consistent over the 5 years. Next, we look at market to book value. All of these companies are continuously exceeding expectations on their earnings, and in result, investors are willing to pay a higher premium for the stock. This is shown because all of the companies are well above 1, and you can see that CBS, the green line, rose in 2016, which indicates that the company is overvalued even more than others in this industry for this year. Looking at economic value added, the numbers are all over for all the companies. You can see that first, looking at the red line, Discovery's management team appears to be conservative. I drew this conclusion because the EVA created a flat line over the past 5 years, so they're pretty consistent when looking at the other companies who are jumping all over the place. Time Warner, the purple, has shown a pretty continuous increase in generating shareholder wealth in return. And looking at CBS, the green, a management team change or inconsistency could have led to the variable EVA. Disney, the light blue, has led the industry in economic value added, and CBS was not creating shareholder wealth as highlighted from 2013 to 2015. Looking at the economic value added spread, once again, for CBS we have an inconsistent trend, which would lead me to believe that during 2012 to 15, they did not have the strongest management team like mentioned previously. Time Warner's upward trend in its economic spread demonstrates a sign of efficiency and good overall performance. Disney, Discovery, and 21st Century all show a positive economic value added spread, demonstrating the company's ability to make money on its capital investments. For enterprise value, Disney has a much higher EV than the other companies in the industry. This makes sense looking back at the leverage ratios because they had the least amount of debt. Looking at enterprise multiple, this shows that all of these companies would be considered to be fairly valued when compared to the industry average, which is currently 10.33. Looking at the current stock price and the projected stock price, you can see that the current is in blue, next year is red, and then 2 years from now is in green. You can see that most of the companies, or all of the companies, are projected to be higher next year and in 2 years, some more than others. So looking at who to invest, I decided that I would invest in Disney from the entertainment industry. They have the least amount of debt. Their earnings are continuously increasing. They pay out a dividend. Their management team has a proven track record, as demonstrated in their economic value. And they have a strong brand that people will continue to invest and buy in, which will help their revenue, which would help their stock price. Next, we're going to look at the telecommunication industry. So first, looking at liquidity with the current ratio, both AT&T and Comcast consistently have a current ratio under 1, so show that they are unable to pay their obligations. This is the light blue and the pink lines. T-Mobile, which is purple, demonstrates that they were not using their assets efficiently in 2012, but other than that, have been doing well in paying its obligations most consistently than others in the industry. Verizon does not show a large proportion of asset value relative to the value of its liabilities except for 1 out of the 5 years, and therefore not a very promising sign. Next liquidity ratio is the quick ratio. As seen in the current ratio in 2012, T-Mobile could have been considered to not be using their assets efficiently, which could possibly be a result of them having too much cash sitting in reserves, as shown again here with the high quick ratio, since they have been on a decline sitting around 1, putting them in an average liquidity position. AT&T, Comcast, and Verizon have again a ratio under 1, relying heavily on inventory or other assets to pay its short-term liabilities. Dish has been the best quick ratio for the industry for most of the years, being back on an increase since they dropped under in 2015. Looking at the cash ratio, AT&T, Comcast, and Verizon have the lowest ratio, again being under 1, showing that there is no sufficient cash on hand to pay off short-term debt, which makes sense since they had to rely on inventory and other assets shown in the quick ratio. T-Mobile drops under 1 for the past 4 years, so they only had extra cash for the year 2012, making me think that they probably sit more regularly around or under 1, like the other companies in the industry. Based on these 3 ratios, Dish, which is the orange line, looks to be high but not too high, therefore putting a fair amount of liquidity to work while still having cash on hand to manage debt. Leverage ratios, looking at equity multiplier, AT&T, T-Mobile, and Comcast all use less debt to finance their assets. They're pretty consistent with each other, sitting around 4, down at the bottom. And then for 3 years, Dish had a pretty high equity multiplier, showing a large part of their asset financing was through debt, but recently have been using less debt. As you can see, their line decreased in the past few years. Verizon has increasingly had a larger portion of asset financing attributed to debt. Comcast shows a promising time interest earned ratio by leading the industry with consistency and shows that they are increasingly able to pay their obligations faster than the other companies. Dish and T-Mobile are sitting pretty low by having income around only 1 or 2 times higher than their interest expenses for the year. Verizon and AT&T The red and pink lines sit higher than the other two but are less consistent than Comcast, paying back debt faster in some years than others. For asset efficiency, we look at total asset turnover, and here we see Dish is generating more revenue per dollar of assets than the other companies, but is currently on a downward slide, moving closer to the total asset turnover of others. AT&T, Comcast, and Verizon all sit pretty low, but it is not much of a concern looking at how the other companies in the industry have a ratio under 1 as well. Firms in the telecommunications sector have large asset bases, so it is expected that they would slowly turn over their assets through sales. T-Mobile is similar to the industry average except for 2013, where they showed to have performed better and generated more revenue per dollar of assets. Looking at profit margin, T-Mobile, the purple line sitting at the bottom, has lower sales or a low market share than the other companies in this industry, and just about only breaks even in profit in 2013. Comcast has a consistent profit margin around 12%, showing that they can consistently manage their expenses. Dish, AT&T, and Verizon have been on an inconsistent rise, showing dips that could have possibly been a result of revenue decreasing quicker than expenditures. Looking at the return on assets, Verizon shows promising signs of earning more money on less investments because of its increasing ROA. Comcast sits pretty steady here like it did with its profit margin, which is a good thing because it shows that it can consistently and effectively convert the money it invests into net income. Due to the low profit margin seen earlier and now having an ROA the lowest in the industry, T-Mobile, the purple line, may need to reevaluate its business strategy. AT&T and Dish, so the orange and pink, fluctuate quite a bit, but still sit around the company average, so could be a sign of poor management not being able to consistently make a profit off of a little investment. Looking at the ROE, the company average is 22%, so even though Dish decreases quite a bit from 2013, their average ROE over the past 5 years is still the highest in the industry, indicating the most growth. However, since the more debt a company has, the less shareholders' equity it has, and the higher its ROE is, so Dish's high debt in 2012 to 2013 is most likely artificially boosting its ROE. For every dollar of equity, Verizon has been generating more and more profit each year, bringing them ahead of the other companies. Even though they fell a bit in the last year, they are still sitting with the highest ROE. Comcast, T-Mobile, and AT&T, the three lines sitting at the bottom, all have a fairly low return on equity, but they show high profit margins and high return on assets, so I think that their return on equity only looks low because the other two companies have above average ROE when it comes to this industry. Looking at ROE decomposition, so what is driving those numbers? For Dish, their increase is going to be their tax burden, and then Verizon's increase in 2015 is from their interest burden. Looking at market value measures, the expected growth for T-Mobile in 2013 was very high, way higher than anyone else in the industry, and this is most likely a result of the expected merger with AT&T, so investors believe that would increase the value of the company. The merger did not end up taking place, and T-Mobile has dropped down closer to the average of the other companies since then, but still has the highest price-earnings ratio as of last year. Market to book value, Comcast, T-Mobile, and AT&T stock are all around 1, so being fairly valued. Verizon and Dish are both being overvalued, averaging with a market to book value of about 9, with exceptions of Dish shooting way up in 2012. In 2012, something could have been expected to happen to Dish, making investors expect higher returns on their earnings, and in a result, were willing to pay a higher premium for the stock. Economic value added, you can see that red, the line in the middle, is Verizon, and their management team appears to be pretty conservative, drawn from the EVA, creating a relatively flat line over the past 5 years. They show the ability to generate shareholder wealth in return by maintaining a higher than industry average EVA. A management team change or inconsistency could have led to the variable EVA for both AT&T and Comcast over the past 5 years. Dish and T-Mobile have trouble creating shareholder wealth, as highlighted from both their lines sitting around zero. Economic value added spread, we look at Comcast and AT&T, who are both, once again, inconsistent, and this leads me to believe that during those years, 2012 to 15, they did not have a very strong management team. Dish and T-Mobile, their cost of capital exceeds their return on invested capital, so these companies seem to be losing money as shown by their negative economic value added spreads. This could be due to inefficiencies or merely a poor investment. Verizon shows a positive economic value added spread, demonstrating the company's ability to make money on its capital investments. Looking at the enterprise value, Verizon and AT&T both have a higher EV than the other companies in the industry. This makes sense looking back at the leverage ratios because they have the least amount of debt and are able to pay it back quickly. Looking at market value, Dish is shown to be overvalued when compared to the average of the other companies in the industry. Current stock and projected stock prices, just like the other industry we looked at, they all seem to be increasing over next year and in 2 years. So who to invest? For the telecommunications industry, I would invest in Comcast. They have a proven profit margin, they have a consistent times interest earned ratio, and in a consolidated industry, their solid EV could lead to acquisition and stock premium.